When you're spending money on something, before you spend the money, and especially if it's a significant dollar amount, ask yourself the question, is this a potential tax deduction? Or how could it potentially be a tax write-off?
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to another episode of Wealth Strategy Secrets. Today we're joined by Amanda Han and Matt MacFarland. Amanda and Matt are CPAs and tax strategists that specialize in helping people use real estate to save massive amounts in taxes and keep their hard-earned money. They help educate investors on how to maximize tax write-offs, legal entity strategies, tax-efficient ways to access profit, and how to use 401k money for real estate. They're also authors of the highly rated book, Tax Strategies for the Savvy Real Estate Investor, and have been featured in prominent publications, including the Forbes Finance Council, Money Magazine, Talks at Google, CNBC's Smart Money Talk Radio, as well as BiggerPockets podcasts. Matt, Amanda, welcome to the show.
Thanks, Dave. Thanks for having us. Appreciate it.
Yeah, you bet. As I was mentioning earlier, really excited to bring you guys on. We are, two weeks post tax season. So appreciate your time and can only imagine what it's like during tax season. But I know this is a really relevant topic for many of our investors, and part of having a solid wealth strategy is really having a good tax strategy in place. I think this is going to be a really valuable show for listeners. So as we kick things off for, people who, maybe not necessarily have heard of you guys before, can you provide us a little bit about, your background and your journey and how you really, got into this tax strategy position?
Yeah. Matt and I met when we started out our career at one of the big four public accounting firms. I happened to end up in the real estate specialty group. So most of my clients were, larger real estate companies, real estate development. And although I grew up in a family of real estate investors, my grandparents invested quite a bit in real estate. My parents dabbled a little bit, but I always was taught just to, get a job, have a stable career as a CPA, and didn't happen to do real estate ourselves until later on in our career.
Yeah, and I remember when I worked at that same Big Four firm, my aha moment that was like, hey, I want to deal with real estate, from the tax side of things I was probably a couple years in. I was reviewing somebody's tax return. It was 60-something-year-old gentleman, retired. Looking at his return, he was making over $200,000 in cash flow, but with the depreciation expense, he wasn't paying any taxes. And that was kind of when the light bulb went off for me. It was like, oh, there's something here, And so, fast forward, we both went to work other places, and then we, decided to start our own firm. For full disclosure, we are married to each other, so. For listeners' benefit there. But so we've had our own firm, Keystone CPA, for the last 15 years. And as you kind of mentioned, we do specialize in working with real estate investors. Probably 85-90% of our clients are real estate investors, whether it's full-time real estate or, working and, investing on the side, passively, whatever the case may be. It kind of runs the gamut. So it's just something we enjoy. It's what we understand. We're not experts in manufacturing or retail clients, but we understand real estate, so.
Sure. So answer me this question. Why in the CPA industry, why are there very few tax strategists, right, versus traditional CPAs?
Gosh, I think that, the first thing is there's not a lot of CPAs who focus on the strategy side, right? When you grow up and you go to school, what we're typically taught is filing tax returns. And so the majority of CPAs you come across who do taxes, their firms are composed mostly of of compliance work, right? Helping people file tax returns and things like that. So that's the first hurdle. There are not many people who are on the strategy side. And then you drill down a little bit more to people who specialize in real estate specifically. That's an even smaller population. I think, most CPAs, like any other business, when you open your doors, you kind of take on all types of clients, right? So if I have no clients and someone comes to me that owns a restaurant or a clothing business, odds are I would take it. So I think Matt and I are very fortunate that by the time we started our firm, we were already real estate investors, and we already had found that need just with our other peers of investors to really realize that this was a niche that, there was a lot of need for within the real estate community.
Yeah, sure. I find that in the market, there is such a misunderstanding of tax. And, through my entrepreneurial journey, it took me, I literally fired over 5 CPA firms. I paid more and more in fees every year. I was constantly surprised by, what my tax liability was because there wasn't any proactive planning. And it became, just super, super frustrating until I had the opportunity to read Tom Wheelwright's book, Tax-Free Wealth, which, I think he's one of the early, thought leaders in this space on tax strategy and how you can think about taxes in a different way as an investor and as a business owner, and how you can kind of, maximize those. So I think people really need to, have a real paradigm shift in their thinking about taxes to be able to properly leverage a tax strategy.
For us, coming from a big four firm, tax planning historically was something that was reserved for very wealthy individuals, right? High income, high net worth people. That's kind of who we worked with when in the big fours. But really, our goal has been to take some of those same strategies, but apply it to everyday investors, everyday business owners, because the concepts are very similar, right? It's just the dollar amount in savings is different. But, someone who makes $10 million and they save $1 million in taxes, that's great. But someone who makes, $300,000 and they save $100,000, now that is life changing for them.
Yeah, absolutely. The only downside I've found to having, a really strong, tax strategy is that traditional lenders really don't like it when you go to them and you're looking for some type of financing and they say, well, your income is 0 or next to nothing. Have you guys been able to kind of cross that hurdle for any of your clients or help assist them in getting financing?
Yeah, for sure. I mean, we get that question a lot. It comes up, especially with real estate investors. They're refinancing a property or looking to buy another property, and to your point, they've taken advantage of the strategies that are available to them to reduce their taxes legally on their tax return. But we get to an underwriter, a lender, a mortgage broker, whatever it is, and they're like, "Hey, your income is too low, or whatever." But so what we advise clients is just to make sure they're working with. And knowing this ahead of time, making sure you're working with an underwriter, broker, whatever it may be, that works with real estate investors and understands that, yeah, you've maximized depreciation expense on your tax return, but that's not necessarily something that you paid for out of pocket. It didn't cost you, if your deduction was $50,000, it didn't mean you spent $50,000 necessarily this year, because you could have used leverage to buy your property and all that good stuff, right? So, yeah, it's just important they're working with people on their team that have the experience of working with real estate investors and kind of know how to navigate that.
And it's sort of like a team sport too. So for our clients, we work with them and their lenders to see, because like Matt said, there are certain things that we can write off on the tax side for a benefit, but doesn't hurt their debt to income ratio, right? So that's the first, we want to maximize those. And then there's going to be things where, you write off on your taxes, it does hurt your debt to income ratio. So then just becomes any other business decision. What is the cost for me to forego some of these expenses as a deduction, and what would I gain from that? Maybe that allows me to get the next property or a lower interest rate. So it's just really understanding the numbers and making an educated decision on it. But we typically see, though, in the hurdles are usually for newer investors, starting out with, it's maybe a couple of single family homes. But typically as investors, scale up their portfolio, that becomes less of an issue because they get into commercial property where it's no longer, based on their income, or they get into alternative financing, creative financing, seller financing, private money, that kind of stuff. So there are always ways to overcome that issue.
Yeah, sure. You made such a brilliant point there, Amanda, about having a team, and through my, journey in this space and kind of creating a wealth strategy, I found that, you're kind of swimming upstream in this space of real estate investing, alternative asset investing, tax strategy. It's just such a unique perspective than the, 99% of the folks that are out there. So your point around creating a team, I've found absolutely critical, which is why we've actually created a virtual family office and a mastermind group, which is, a team of different experts in their specific domains, so that everyone is like-minded and speaks the same language that can support you and your goals. But I've had, countless new, discussions with, clients, let's say entrepreneurs that are trying to work on a tax strategy because they're exiting their business, right? And they're trying to really optimize for that. But some of the ideas that, you guys are probably familiar with, we kind of talk about, most tax attorneys, most M&A folks are just not familiar with these ideas. And it can be, really frustrating, right? If you don't have a great team around you to get there.
Yeah, I mean, even for us, because I think that it's hard for you to be a specialist in all these different areas. And that's why kind of the team approach is so important. Even within the tax world, we have colleagues that specialize maybe in charitable planning and other people who specialize in the estate side, which we can help plan, but we might not be as specialized in that specific area or scenario. So I think, it's really important. And sometimes taking the client out of being the middle person, having to translate, like, this is what my attorney said to the CPA and vice versa. I think that's what I love about your mastermind concept is everyone is, kind of coming to the table together.
Yeah, sure. So can you share with the audience some of your, top strategies that you could, recommend to folks that you've, seen people put in place?
Gosh, I mean, there's so many strategies. I don't know.
Yeah. So if you could just give, let's go simplify this. Like if you could give just your top 3 tax strategies for, passive investors, what would they be?
Yeah. Well, so, I mean, if we define passive investor as someone who, just maybe is working full time or still has a business that they're running and they're just doing real estate on the side, I think there's a common myth that investing in real estate passively gets you no tax benefit at all. And that's really far from the truth.
Yeah, because you think about it, when people are investing passively, obviously the goal is that they're investing in, I guess not the goal, but a lot of times they're investing in like syndications, right? So some, company goes out there, syndicates a deal, buys an apartment building, mobile home park, whatever it might be. When you invest passively in that deal, your goal is obviously to generate, to receive cash flow from it. So, people need to look at it from the perspective, hey, I'm getting, question comes up a lot. I got a $20,000 distribution check this year. So that means I'm paying taxes on it, right? Well, actually, probably not necessarily. It's like even the first couple of years, because of depreciation and things that the syndication is going to do inside the company, you're likely going to pay very little income taxes on that $20,000 distribution in year 1 or 2, and might even show a loss on your K1. So that by itself is a huge tax advantage. I think people forget about is that they've got $20,000 in their pocket in our example and not paying any income taxes on it right now. So that's that is tax-free, tax-free wealth, right? Tax-free cash flow.
Yeah. And I think, for most people to be a passive investor in these types of asset classes, you have to be accredited, which means you're either high income or high net worth, frequently translated into high tax bracket. And so for people like that, if they're paying between federal and state taxes, if they're not in Florida, like if they're like us in California, and you're paying high taxes, it's really, really important to understand that real estate is one of the few asset classes that allows you to have income like cash flow without increasing your tax. So I think when tax advisors say, oh, there's no benefit because you're just a passive investor, they're really doing a disservice, right? They're just looking at a tunnel vision saying, oh, maybe it's not offsetting taxes from your business, but certainly it is helping to reduce your overall taxes because now I've made more money and I'm able to keep all that profit without losing 40, 50% to taxes, like my business or like my W-2 job.
Yeah. Yeah, for sure. And then another piece that I learned, I think that was really important along the journey is that, I think if you're an active participant in tax strategy, right, with your, tax advisor, then you think about the world differently. Every time you go on vacation, every time you purchase something, whatever it is, it should actually be part of, your decision-making process, right? Because there's typically a way to, get, tie it into your strategy. And, one of my best examples of this, for us was we actually purchased a property in Italy about 10 years ago. And so, we rented it for like 1 month out of the year, but we were able to travel there tax free. We got to go visit our asset. We were able to put our kids into the business to help kind of work on that. And even a side benefit of that was teaching our kids all about the strategy, right? In a really real and meaningful way. So do you have any additional thoughts on what people could do to learn more about tax strategy, be positioned ideally to really take advantage of some of the opportunity?
Yeah, I think you brought up so many great points. I mean, it's being, first step is just being proactive and having that open line of communication with your tax advisor, with the rest of your team of advisors, because, you're the person who knows what's going on in your life, right? So like we don't know that you're potentially selling a property unless you tell us, right? So just having an open line of communications. And I think once you start that process, it becomes a lot easier. And doesn't have to be an hour-long conversation. It can be as simple as a quick email saying, hey, I'm thinking about doing this. But what that does is, in our experience at least, obviously we can help you better, but it also helps the clients get more in that frame of mind of, this is what I'm thinking about when I'm doing things. I'm thinking about it ahead of time so that, when I'm planning that business trip, or, it could be as simple as going to the, store to buy supplies. Like, hey, how does this relate to my business? I mean, that's, very good, could run the gamut, right? But it's all along the same lines of thinking as, how are we incorporating, being proactive in our planning process to kind of achieve our goals.
Yeah, and I think even in just that one personal story you shared, it encompassed so many different things that we always talk to clients about: pre-planning for a trip, income shifting to your kids, which is great, but also income shifting to family members. If you have parents who are retired or semi-retired in a lower tax bracket, why not take them with you on the trip, making sure that they're doing what they can to help out with that particular property and real estate. So, one tip we tell investors when we do these type of educational events is we tell them, when you're spending money on something, before you spend the money, and especially if it's a significant dollar amount, ask yourself the question, is this a potential tax deduction? Or how could it potentially be a tax write-off? And if you don't know the answer to that, that's what your tax advisor is for, right? Like Matt said, send an email, do a quick phone call. The word how is so powerful, and because we've done, our clients have put this back on us as well. It's like, hey, you talk about how. There's something interesting about that word that kind of puts you in a different mindset when you are, when you're thinking. So, can I write off my trip to Italy? No, I cannot. But how can I do it? Right? How can I do it? Do I have all the real estate activities arranged ahead of time to do so?
Yeah, that's such a great way to put it, and to always be thinking about, how you can position that. And I think for some of the folks who are listening who might be, W-2, high income earners, we're always thinking about how can we add value to our clients, right? Or solve some of the problems that they have, right? So for instance, if you're, a W-2 income earner and you don't really have some of the opportunities that a business owner does, one thing, we actually have an oil and gas fund, which is 100%, tax deductible, as you know. against your investment. So on active income. Which has been, really powerful for folks. And then I always tell folks that, hey, okay, even if you don't have a business, how about starting one? You might actually have, you might have a passion or a hobby or an interest, or maybe something with your spouse or your family that you can start to develop, and then start, at least moving some, creating an additional stream of revenue, and then start to put some expenses under there. Any thoughts around, ways that W-2 people can do that, or if that makes sense from your perspective?
Yeah, I think, one important thing for people to understand is that as a real estate investor, if you own rental property, even if it's passive, one turnkey rental somewhere, you are still a business owner in the eyes of the IRS. So when we talk about maximizing your write-offs through, business development, travel, business meals, all that kind of stuff, it is available to you, simply because you are in the business of real estate investing. Right? You don't have to have an LLC or a corporation. It's just available because you are a real estate investor. And this works regardless of whether you're W-2 income or, doing real estate full time. But I think, for folks who are high W-2 income earners, but also interested in real estate, we work with them a lot on the short-term rental tax loophole, because that's a really great way for people who have real estate as a side hustle, but still really be able to receive some really powerful tax benefits.
Yeah, I mean, there's ways with short-term rentals that, if clients are willing to self-manage it for, the first year or so or a year or two, there's ways that you can create losses on that through, accelerating depreciation, cost segregation studies, and use those losses to offset their W-2 income, just because they are self-managing those short-term rentals. So a lot easier to, in our experience, a lot easier to kind of be able to do that than maybe trying to be a, what they call a full-time real estate professional or something, where you're full-blown into real estate, obviously.
Yeah. I mean, we have people who make like $300,000 and they're able to write off over $200,000 against W-2 income using that loophole. So, definitely one that a lot of our high income clients are looking at. But I loved your example about oil and gas, because we also have a lot of clients doing oil and gas. And, in addition to that really great first year benefit of being able to write it off against all different types of income like W-2, what also happens a lot is in the future years, right? When now this investment is kicking off royalty income, most of the time that's passive income. So if I've written off my investment in the first year, in the second year, if I got, $30,000, $50,000 of royalties from that investment, now I can use my rental losses or losses from other syndications of real estate, maybe that I've invested in, and really being able to pay no taxes, right, on that income from the oil investment too. So we've seen some phenomenal tax benefits multi-year.
Yeah. And can you explain a little bit about IDCs and depletion?
I mean, I can a little bit. Like, we have clients that, like from the investor side, we don't have the clients who are actually doing the drilling and things. But yeah, basically the IRS is allowing people, when they invest in these oil and gas partnerships that are doing the drilling and things like that, that you can write off a huge chunk of those drilling costs, if you will, in the first year. So to your point, sometimes it's, it can be 80% of your original investment. We've seen it up to 100% of original investment. And if they're structured the right way, then those losses are non-passive, and where it allows you to offset against your active W-2 or business income, whatever else you have going on.
Sure. And let's go back to the real estate professional status. So maybe first you could just give a high level overview for people on, what it is, what it takes. I know it's 750 hours, but you could kind of just explain that briefly. And then the second part of that is, do you see that kind of, phasing out as bonus depreciation starts to sunset here and people are starting to look at other strategies, or what are your thoughts from their perspective?
So real estate professional really is important for people who have higher income, so over 150,000 of income, and have rental losses, whether it's natural losses from the investment or losses strategically created. Because if you are not a real estate professional, those losses are considered passive losses, which means they only offset taxes from passive income and not W-2 income. Right. And so one of the goals of a lot of people is, hey, I'm investing in real estate. How do I use my rental loss to offset my W-2 income or my business income? And the way to do that is if you or a spouse is a real estate professional. Real estate professional has nothing to do with licenses, whether you're a realtor or a broker. It simply means you have to spend the right hours on the right activities during the year. So a couple different tests. You have to spend more time in real estate than your jobs or businesses combined. So if you're working full time at 2,000 hours, you have to have more than 2,000 hours to be a real estate professional. But if you don't work full time, or if you have a spouse who's not working, then you just have to have at least 750 hours in real estate activities. And then the third part is you have to meet material participation, which means more active hands-on hours with respect to your properties. And that's 500 hours. So if you meet 3 of those requirements, then the benefit is you are a real estate professional. Hence, you can use rental losses against W-2 and business income. Now, the key distinction here is we're talking about long-term rentals. So if you own long-term rental investments, you have to be a real estate professional to use the losses when you're a high income earner. But if you are a short-term rental investor, Airbnb, Vrbo, things like that, IRS actually doesn't care if you're a real estate professional. You just have to meet that third test, which is material participation. And again, that's the reason why, depending on what your profile is, if you have a job full-time or not, the decision of what type of real estate you do, long-term, short-term, mid-term, can impact how and when you benefit from the tax losses.
And to your second question about bonus depreciation kind of phasing out and whether it's going to take away kind of the benefits of real estate professional, I see it maybe a little bit. I mean, obviously trying to do, if someone's doing trying to accelerate as much depreciation, get the benefits up front. This year we're not at 100% anymore bonus. We're at 80%. I mean, that's not 100, but it's better than 0, obviously. So the power is still there. But fast forward a few years when it is set to kind of phase out 20% per year. I wouldn't be shocked that by that time comes in a few years that it gets put back into place. I mean, it's been here in some form or another for the last 15, 20 years from what I can recall. So I wouldn't be shocked if it's brought back, at least to some extent in a couple of years without actually going away entirely.
Yeah, good point. I mean, benefits around energy have been around since the Reagan era. So, there's quite a bit of history around that. And again, kind of going back to that paradigm shift, right, that's interesting is, the government's actually looking for you to partner with them, right? Because when you're doing things like, energy, right, it supports our GDP across the country, it supports our national defense, right? So many different things across industries. Real estate, you're providing housing for people. So, businesses, you're providing jobs, right? So that's why those incentives are actually there. And I find it interesting as well, sometimes the psychology around taxes, people talk about, the word loopholes or, people cheating on their taxes and things like that. But I think for the educated and the people, who really understand it, it's more just about a strategy, right? And leveraging the strategy, and that, the tax code is really a series of incentives, for business owners and investors.
Yeah, that's exactly what it is. They're incentivizing you to do what they want you to do, right?
Yeah.
Yeah.
And I think in reality, they are both. There are incentives and there are loopholes, right? The incentives are, like you said, why do we have bonus depreciation? Why do we were able to write off 100% of meals in 2022? Because they're trying to incentivize you to invest, right? Or eat out to the restaurants when the restaurants were suffering during COVID. And then there are loopholes. It's just like, maybe that was not the intent of the tax law, but this is kind of just, what happened because of some court cases or they missed out. I think that the short-term rental space we're talking about, that's likely a loophole. I don't know that the government is really wanting to incentivize people to do more Airbnbs.
Yeah.
I think definitely both exist in the world. And that's also really important as part of tax planning, is to make sure you have a good advisor, because these kinds of things are always changing too, right? What could be a loophole right now might be closed or might be modified. So really important that your team of advisors is staying on top of all those changes as it comes down the pipeline too.
So that's a perfect segue. Do you see anything, right? It's now, we're just finishing April 2023. So going into the remainder of the year, any changes, key changes do you think that people should be aware of?
I mean, in my thought process, and all political commentary aside, like President Biden and his team have kind of at various times over the last couple of years have tried to bring proposals to the table, and they don't seem to kind of get anywhere, for a lack of a better term. So now I know he just announced that he's wanting to run for re-election, and so it's up in the air what happens, right? But I guess if I was a betting person, I wouldn't say I'm not expecting anything drastic to happen in the next year and a half, but again, things can change overnight, obviously.
Yeah, I mean, I think the traditional things you hear on the chopping block, taking away, real estate, the unfair real estate tax benefits. One example is getting rid of or limiting 1031 exchange. Those things just are brought up time and time again. Every time there's a budget, that's always included. But I think, like Matt said, they really haven't gone anywhere. And our expectations is probably just more of the same. Hopefully, right? Not having that go.
Yeah. Well, the other thing I find quite interesting around this is it always depends on, which congressmen have a stake in certain things. Classic example is the Augusta rule. Right. Where, you can basically rent out your house, and, they clearly had some houses, in Augusta and wanted to take advantage of that. So they wrote a law to be able to support that. So
that's as easy as it goes. You just write a law.
But, it's interesting, though, that although that's been, that loophole has been in existence for so long, but there's still a lot of people who don't understand it or who don't know how to use it correctly. Right.
So can you unpack that one quickly? Because that is a pretty cool one that I think a lot of people aren't aware of.
Yeah, I mean, it refers to that situation where if you do rent a particular house for less than 14 days during the year, that the money you receive for doing that is totally tax free to you. So situations, you'll see it obviously Augusta and the Masters golf tournament. Out here in California, there's a lot of music festivals and, Palm Springs areas. So I think people do that sometimes where it's a second house, but they rent it out for 2 different weekends, and they, collect who knows how much money they can get for those things. But that's one of those things where it's just basically tax-free money to you. So yeah, it can work well in the right situations.
Well, it also makes sense to, as a strategy, even if you're not renting it out to the public. We have clients who just have, beautiful, phenomenal homes, and they'll hold events for their businesses. So if they have a corporation and they want to host their top clients or their internal team at their house, for a mastermind group or some kind of training event, they can also, the S corporation or C corporation can pay them to rent the house. It's still the same concept, same strategy, that it's a deduction to their business, but non-taxable to them individually too.
Yeah, I was just going to add to that part. It is a great strategy if you're a business owner. So another question I think that would really help the audience is also really understanding recapture, right? Because I know there's some complexity around this. We have investors that are up to 50 different syndications, and, how are you planning, different exits and what, recapture? There's so many different variables there. But can you help to explain to the audience, what recapture really is, and then how can you kind of plan that as part of your strategy?
Yeah, I mean, recaptures really is, obviously when you, high level, you buy an investment property, you pay, pick a number, $500,000 for it. You take $150,000 of depreciation on that property over time. For tax purposes, your basis in that property now is down to $350 because you've expensed $150,000. So whenever you go and sell that asset for anything more than $350, the first $150,000 of any gain is going to be called depreciation recapture. So basically, they've given you this deduction up front. They're making you pay it back on the back end. Now, a lot of people think that's a terrible thing. Like, oh my God, why would I take depreciation if I have recapture in the back end? But keep in mind, a lot of times, especially for high income earners, when they're taking the depreciation, they're saving taxes at 32, 35, 37 cents on the dollar. But a lot of times when you do the recapture, it's good chunk of time, it's set at a statutory rate of 25%. So you can still come out ahead. Now, and fast forward to kind of from a planning perspective to, kind of your point is, when you were doing a lot of different investments or passive investments, syndications, there's going to be varying exit points in time, right? I mean, you usually an investor can't control that. The sponsor or the syndicator is doing all that. But again, that's where it's having that kind of open line of communication with the sponsor too. Like, hey, what is coming down the pipeline in the next 6 to 12 months? Are we expecting any exits? If so, kind of what, we have an idea of what, my share of the gain or loss is going to be, because it's not always going to be the same as the cash you get. So that's something important for an investor to know. And then you take that information and you again have that conversation, open dialogue with your tax advisor, and say, here's what's coming down the pipeline. What can we do to minimize this? There's things that you can do to minimize, the sponsor can do to minimize recapture by allocating sales price at different types of things. But from an investor perspective, it's looking at holistically, like, what do I have going on? What tax attributes? What carry forwards do I have? Can I sell something here that maybe isn't a loss position? I can offset some gain. Can I reinvest some money in another syndication before year end to offset that gain through depreciate? All kinds of different things. But it's, again, I think it goes back to what we're talking about, just having an open line of communication with all parties involved.
Sure. No, that's helpful. So let's take the scenario that an investor wants to get to tax zero. Okay, they have real estate and other investments and things. Is there anything else as part of your strategy that you could recommend that would be beyond, let's say, buying assets, right? Because if you're always buying, then you're resetting that clock on depreciate. You're getting the depreciation, whether that be active or passive, on those assets. Clearly, if you have a business, right, you have certain deductions, different things. But just kind of from an overarching standpoint, is there anything else really from a strategy perspective that people could do, to really mitigate that tax burden?
Yeah, it's definitely possible to get to zero tax, and actually that's available for every single person. But you have to have the right facts, right? And it might not happen in first year of planning. It, typically is going to be multiple years of getting from, let's say, 35%, 37% bracket down to zero. Some of the pillar strategies that we talked about already, real estate, but outside of real estate, we look at entity structuring, right? How do you shift income into different entities so that you get low or zero tax rate? What about shifting income to other family members who might be low or zero tax rates? Shifting income into retirement accounts, right? You can have 401ks, defined benefit plans that get your personal tax rate now, personal or business income, down to as low as legally possible. Also shifting assets or income in the future to charities, right? We have a lot of clients who are very charitable minded. And, it's what we call doing well by doing good. So not only are you helping charities that you're passionate about, but also getting a huge tax benefit in the interim too. So, there's definitely ways to do that. We see that time and time again with clients. But, it's not as easily done as, like hear about it and just go ahead and implement. It does take, quite a bit of work and maybe over several years with your tax advisor to kind of reach that ultimate goal.
Yeah, no, that's really great insight, right? And really just thinking about it, strategically and working with your tax advisor kind of on a proactive basis to really do that, right? Versus the opposite, which is more reactive, which is just send me all your historical, what happened over the past 12 months. And then, your tax planner can't really do anything, with it. But if you have that good relationship, that good communication, you can start planning for things ahead of time. And I really think, I really appreciate your time, guys, and coming in and sharing these insights because, this is, to me, such an understated opportunity in the world of investing and how people are really trying to grow their wealth. And, the ultra wealthy have completely figured this out. Right. So if you look at their portfolio allocations in Tiger 21 and ultra high net worth groups like that, right, over 50% is in real estate, private equity, and these alternatives. And part of the key reason is because of these different tax benefits that you can get, right, drive up their overall wealth. Because, for instance, if you have, let's say you're looking at a particular ROI on a deal, and maybe one is 10%, maybe one is 15%. But what if you could actually reduce your taxes by 10, 20, 30%. That could be even bigger than the investment return itself, right? And then if you add that on top of what the investment is doing, like it's really exponential. Any, yeah, for sure. So any parting words of wisdom in terms of if you could give just one piece of advice to listeners about how they could accelerate their wealth journey, what would it be?
I think I know we talked a lot about different tax strategies and ways to save taxes. And for some of our listeners, it might be a little bit overwhelming. But I think the key takeaway I would leave listeners with is that the goal here today is not for you to become a CPA. It's not intended for you to understand how to calculate depreciation or, do any of that stuff. But it is important to make sure that you have the right person on your team when it comes to tax planning and tax strategies, and making sure that you have that line of communication open with them to consult with them prior to making any significant financial moves. Because then your team can help you with guidance on, here are your options and opportunities that you can take advantage of.
I think the thing that comes to my mind actually twofold is for those people who are maybe early on in the journey in terms of wealth building, I would, my advice would be to pull the trigger and get started. You're trying to, you're working the W-2 job. No better time to get started and start earning that, passive cash flow and some other stream of income as you can. And then for those people who are kind of farther along in their journey, I would just recommend maybe, look at expanding your sphere of influence. Who are the people around you that you're surrounding yourself with, and are they going to help you get to your goals, or are they the right sphere of influence for you, for that matter?
Yeah. Awesome. Love it. Really appreciate it. And if people want to reach out and learn more or want to, kind of work on their own tax strategies with you guys, what's the best place?
Best place to find us is on our website. It's keystonecpa.com. I got a lot of good information on there, a lot of resources, a lot of, free resources for investors, all kinds of different things on there.
Yeah, we have a free tax savings toolkit, which people can download. Part of that is a self-assessment tool, because I think one of the most frequently asked questions we have is, am I paying too much in taxes? Unfortunately, we don't know the answer to that, but we've developed this self-evaluator. You can go through, answer some questions to kind of see where you rank in terms of risk level. And the byproduct of that, I think, which is really awesome, is that it gives you clarity into what are the areas where you might be deficient in. And that's what you can take to your tax person, kind of as next step for planning ahead. For any of our listeners who are on social media, I am mostly found on Instagram as Amanda Han CPA, and try to post daily tax tips.
Awesome. Love it, guys. We'll definitely link to those in the show notes. And again, thank you for your time and providing so many valuable insights for the audience today. Really appreciate it.
Yeah, thanks for having us.
Thanks, Dave. Appreciate it. Thanks for having us.
You bet.